Welcome to the perfectvariableannuity.com. This is a site that we built really to try to help investors who own variable annuities to take control of those assets. And as we always say, this isn't about one specific annuity. This is about building the perfect variable annuity for you. And, you know, in part one of our 6 objectives of a variable annuity, we talked about tax-deferred growth for future income and how to keep it simple. On part 2 here, as far as the second objective, is actively manage your money. The beauty to me of a variable annuity is that you have the ability to actually proactively manage your money and not have to worry about tax liability. In other words, the tax-deferred growth component of this is that you can switch between portfolios and not have to worry about what the tax ramifications are. And as you can see here, actively manage your money. 1, define a disciplined strategy. 2, manage market risk for your tolerance. And then thirdly, clearly define objectives and time frames for that. So what we have done within the perfect variable annuity is here at the top you can see what we call the sector rotation model. We actually have built a model for you to follow along. So the whole idea is that we want to manage money on a proactive basis, not a reactive basis. And what I mean very clearly by that is that most investors react to the market. In other words, the market falls 10%, we get panicky, we sell. That's reacting to the market. Proactively managing your money means that we are taking action prior to a lot of those things transpiring. In other words, I'm not saying you're not going to lose money. I'm saying that you're going to limit the losses within your portfolio by being proactive relative to how the assets are managed. The second part of that is you have to have a variable annuity that allows you to make those transactions or changes and offers you enough choices that you can actually take advantage of what's available in the marketplace today. We have found approximately 8 variable annuities out there today that allow you to have what we call unlimited transferability of assets. In other words, they don't say you can only make 12 transactions a year. They're going to say you can only, if you buy a certain mutual fund, you may have to hold it for 7 days, 30 days. They may say to you that if you buy this particular portfolio, that you can trade it tomorrow. In other words, you can buy it today and sell it tomorrow, meaning there's no holding limitations. So I think those are the keys of what you want in an annuity so that you can actively manage your money. And quickly, I want to look at, I'm going to pull up, this is a piece of software that we use to do just this, which is proactively manage the money. And over here on the left-hand side of this is you see a table, and these happen to be mutual funds. And the reason we have mutual funds is unit values are not tracked on software at this point. So we use the mutual fund that closely indicates or is close to what we see in an annuity product that we can track. And if we can find those, then that's great. If not, then we'll use the index mutual funds like the S&P or the NASDAQ or the Dow to track those particular investments. And what I have up here is on the top chart, this is just a daily chart, and it's a line chart that shows you what's happening within the trend of the particular mutual fund that we're looking at. This happens to be, I have XLB, which is actually an ETF. So let's flip over to a mutual fund. This is, let's find one that is more in line with what we want to look at, biotech. And then the bottom is a weekly chart, which happens to be a bar chart, which does the high, low, and close on the bars for the entire week. And so what daily gives you a shorter-term compressed view of the market. Weekly gives you a more elongated or longer-term view of the market and or the asset that we are looking at. And we're using biotech here as an example. And I want to scroll this back just to look at some things that I think are very important for you and I to consider. And I've taught this for a long time, and to a lot of different people And the one person that I practiced this on so that I knew that I was making it simple enough that we could all understand it was my daughter. When she was 8 years old, I would teach her that if the line of the chart from left to right is going up, that you want to own it. And if the line or trend of the chart is going down left to right, you do not want to own it. So as the trend is to the upside, you want to own it. When the trend is to the downside, you don't want to own it. And if the trend is sideways, like we see right here, then, it comes into play as to what we should do with it is really a flip of the coin, because we're going to have to figure it out. So let's take and draw a line. I got the wrong tool. Put that right up there. Let's take and draw a trend line across here, and you can see that the trend is moving higher. So what we want to do is we want to own this as the trend goes higher. And then you see it go vertical, or it actually goes what we call a climax run to the upside. Well, to me, that becomes more of a concern as it gets higher. So it goes higher, it channels around it, and then it breaks below it. And we may say, all right, we're going to sell it right there when it breaks below that line, and we get out of the position at $31.10. And if we bought it somewhere back in here, let's say at $25.50, we lock in a gain. Remember, because we're in an annuity, we don't have the tax liability. So the key to me is that you want to take a proactive stand relative to what's going on. And when we talk about sector rotation, if we look at this from the standpoint that the S&P 500 index, we can put it up here, and we can see that it has very similar trends, very similar of everything. And what this is for is that, let's say you can't find an annuity that allows you to do some of the things that we talk about on the website and on the videos, that you only have a limited selection, but because you have a surrender charge you don't want to take, you can still find within these generally funds that mirror the S&P 500 or mirror the NASDAQ or the OTC, the over-the-counter market, which is what the NASDAQ was called originally. And when you look at those type of big indexes, you're going to find them in there. Technology, healthcare, those type of funds you will find. What you typically don't want are age-weighted funds where it says that if this is 2010 and we're looking out to 2020, then I'm going to buy an age-weighted fund for me to take money at 2020, and they manage the money based on my age. I'm not a big proponent of that. Don't like it. Don't really think that it works all that well. I know they've tweaked and tried to change the models on those, but I'm still not buying into the whole idea of that going forward. But what you want to be able to do is know what you own. In other words, if you have an S&P 500 index fund, you own the S&P 500, you own all 500 stocks, and your fund will actually track along with the S&P 500 index, so it allows you to be able to track and look at what's going on with the trends of those assets. And I think that's very important. We can look at, if we look at the NASDAQ index, you can see very similar type of movement in the index. If we look at the Dow Jones U.S. Technology Index, you can see what happened within tech. And you take it when the trend's up, you get out of it as the trend goes down. You're not trying to time the market. You're just trying to follow the trend of the market. And I've always said for years that if we had room on this chart right here, we could pull this back, and there's the 2009 and 8 correction. Well, if you were following this uptrend, that was your trend to the upside, then somewhere in here you got out of the market, and guess what you missed? That. And then it goes back. It creates another trend to the upside. You follow along. And then when it breaks it, you get out. And when it trends up again, you get in. When it trends down, you get out. And I'm oversimplifying this, obviously, but for illustrative purposes. But my point is, we make money management, I think, sometimes way too complex. We want these models that are going to dampen risk, dampen volatility. You want to dampen risk and volatility, take your money out of the market. You want to increase your risk, put money in the market. And that's really the bottom line of the markets. Now, we can all talk about the various technical indicators and fundamental indicators that determine risk and volatility, but most investors really are not that complex. I mean, I know, and if they are, they generally aren't trading their money in a variable annuity. They're doing it in stocks, options, or other things that will give them what they think are maximum returns for the risk they take. And that doesn't make it right or wrong, just means that's the way they choose. That's the strategy that they develop. So we created an active managed portfolio for you to follow along. And if we go to the top and we click on sector rotation model, the sector rotation model is quite simply, the model that we built from the standpoint of what we're looking at is how do we manage this on a day-to-day basis. In other words, what we're going to do is update, what we see going on. Do we want to add things to our watch list? Do we want to add things to the model? Do we have stop alerts that went off today? And stop alerts, because you can't put a stop on a variable annuity, we use what are called alerts. And that means that if we think that the price is going to fall below based on today's activity, we exit the trade. In other words, we exit the position and we sell it and we get out of the position. And so we have stop alerts, and then we have stops that were hit. So we're going to tell you what's on the watch list. If I just have a couple here, reverse index on the S&P 500. In other words, if these are on the watch list, we think the market's going down. And when the market starts to trend down, then we want to own the inverse funds of the S&P 500 or small cap or NASDAQ. There are variable annuities that allow you to track the inverses of the index. And then what we want to do from there is we want to manage the model itself. In other words, we want to manage the positions. And you can see at the time that we produced this video that there were 4 positions inside the fund model. You can see what the rating is. It's going to be buy, sell, or hold. You can see what the entry price is, the entry date, the number of shares purchased, the profit and loss of the current position, the stop alert, the target, in other words, what we're looking for the price to attain. And then you can also see the ROI, which is return on investment, and then the money allocated, and then the max that we recommend that you allocate to the portfolio. And then you can see all the other things here. You can tell by the fact that there's $126,000 that started with 100. We actually launched these portfolios on 9/1 of 2010. So they've been in existence, the model, for over 13 months. And so this isn't something new that we just decided. We've actually been doing this by these model allocations for more than 5 years. But we decided to design a model. We launched the model over a year ago, and now we've actually decided that we should put these into the Perfect Variable Annuity website so that you have something that you can follow along with. And that's how the models are built. Our focus is to give you information each and every day. If you want to go to the website every day, it's updated every day, and you can read and follow along with what we are doing and how we are doing it relative to the annuity model. The focus for me isn't the performance. The focus is the risk management. In other words, we want to manage the risk of the asset. Why do you invest money into the stock market? The obvious answer is to make money. In order to do that, we have to manage downside risk. In other words, you don't want to give up profit. Think about this. If in 2007 you made 10%, let's say, and by 2008 you lost 25%, and in 2009 you make 30%, you're making yourself schizophrenic. You're riding this roller coaster, and most people, just by nature, as we get older, we don't like risk. We tend to avoid risk, and that's just a mindset or psychological thing that we have. And I turned 52 this year in 2011, and I can tell you I don't like risk. The older I get, the older I become, the less risk I want to take. And I think that's really what you want to focus on when you're managing your annuity is how do I manage the risk to get the return that I'm comfortable with. A lot of people that I talked to today are very happy making 9, 10, 11, 12% on their money without taking a lot of risk. And I think that's one of the things that we all have to focus on. So our model is built on this premise. The model is built on making 1% per month without a lot of volatility. In other words, we don't want a lot of losses in the portfolio. It doesn't say that there won't be losses in the portfolio. In fact, you can look at right here the archived model trades, and you can see all of the trades that we've put into the portfolio since we launched the model, and you can see that there are going to be times when we make money and there are going to be times when we lose money. And you can see the key where the minus signs are there is that we want to limit the losses and we want to maximize the gains, and we don't want to give gains back. And that's as simple as it gets. And that's how the model was built. It's how it's designed. It's how it's run. And it's how we run it every day on the website. So you can actually follow along. And to me, I think it's very important as an investor that you take a proactive stance to managing your money versus a reactive stance to managing your money. So be active, and that's what we built here. So one of the 6 objectives of a variable annuity is to actively manage the asset. Define the discipline strategy. We just did that relative to the model. We manage the market risk based on what we have as a goal. You have to manage the market based on your risk tolerance, clearly define the objective and the time frame by which you want to do it. And you can follow along on the models each and every day. We do also offer the opportunity through our advisory firm, which is Money Strategies Incorporated. We will actually manage the model for you. If you want to do that, we have a way that you can do that. You just call us at 800-369-5759, and we'll be happy to get you the information, or you can send us an email. You can send it to me, info@Money Strategies Inc., MoneyStrategiesInc.com, and we'll be happy to do that for you or give you the information if that's something that you'd like. Or you can simply go to the website, which is perfectvariableannuity.com, as you see on the screen, click contact, and it will set up a way for you to contact us via email and or phone or any other way that you choose to do so. So there it is on the screen for you. With that, we'll stop here. That concludes objective number 2. Please follow along through all 6 objectives. I think it'll give you a clear view of how we're going to manage money through the perfect variable annuity.